Good evening, friends. A very warm welcome to all of you all on the fourth quarter's call from Renaissance to give you an update on the market outlook and obviously discuss our portfolio strategy. So, uh, without much ado, let me straight away delve into how we are thinking about the market. Last 8 weeks or 10 weeks have been very eventful from a market perspective because we've seen markets have had a meaningful pullback. And in middle of all of this market pullbacks, we've had our own budget a few days back at the start of the week on Monday, which is the first full-fledged budget of this government in this term. So for whatever significance it has, we'll discuss that. And on top of that, we've had a change in government in US where the new president is taken office. And obviously, all of us know that his approach to policy making or his policies are very much extremely divergent with the last government. So, what does that mean? And we've already seen first few announcements and retracement from him. So, what does that mean from an equity perspective and more importantly from our Indian markets perspective or economy perspective? So, I'll try to cover all of this over the next 45 minutes or so, and also touch upon, give you all an insights into performance of our funds across PMS and AIF. And thereafter, we'll open the floor for questions so as to answer any specific question that you all might have, which I would not have covered. So with that, maybe let me straight away begin with a update on the quick update on the economy and how we are thinking in terms of markets and economy. So let's begin with the economy. I think we are an important juncture in the economy. All of us know that we've had our budget just 4 days back. I think the most important thing which I think I had spoken about in our last con call when we met last spoke in October, and after that it got further confirmed with more data points and it's become now prominently evident, is there is a deceleration in India's growth rate. So what came surprising was second quarter, September quarter's GDP number when they came out in early November. India had a 5.4% GDP growth, probably the slowest that we've seen in the last 20 quarters. More importantly, there is a downward shift in growth where this year's growth, this financial year growth, FY25 growth now for India is going to be about 6.5% as compared to now. That's a meaningful, downward revision versus the growth that we had in the last year, March 24 or FY24 financial year of 8.2%. The government has been somewhat late in acknowledging the slowdown in the economy. More importantly, I am of the view and we are of the view that given the environment and given that from here on, globally there will be probably more headwinds for global growth given more trade embargoes and more nationalistic agenda from US. Probably our view is, one view that has changed is now India's medium term growth. When I say medium term growth, I'm talking about growth over a 3-year time span, including this current financial year. We think India's medium term growth will be about 6.5%. So this is in a context step down from the growth that we witnessed in the last 3 years post COVID. After the strong rebound that we had in FY22, our 2 years we've had very strong growth, and the 3 years post COVID our average growth has been about 7.5%. From there, we think there is a 1 percentage point decline in India's growth trajectory over the next 3 years, including this year. So that's one change that has happened from economic environment point of view. Having said that, even at 6.5%, the silver lining is India will still be the fastest growing economy in the world. From a budget perspective, I think one good thing or few good things that clearly emerged out of the budget, and there is a pivot in government approach as well in the budget. Clearly one big thing from a macro perspective has been a very significant fiscal consolidation that India has achieved. All of us know during March 21, post-COVID, in the year of lockdown COVID, we had a big fiscal expansion and our fiscal deficit went to 9.7%. From there on, we have been on a path of fiscal consolidation, and probably next year the government is targeting, and I think it's pretty much achievable. So I think one thing we have to credit this government for is been very prudent in terms of fiscal management. So next year targeted or budgeted fiscal deficit at 4.4%, which is a very healthy 40 basis points of consolidation over the next year, after having achieved 80 basis point consolidation this year. So which is pretty encouraging, and more importantly, in an environment where globally things are looking a bit volatile and headwinded, where the world is global trade is going to get more headwinded, India probably is in a very good, India has got a very stable macroeconomic backdrop, or India's macroeconomic fundamentals are very healthy and strong, and I think that's a good thing to be, or a good position or situation to be in, getting into an environment like this that we are getting into. From a budget perspective, clearly there is one big shift or pivot that has happened from a government's perspective. All of us know one of the big drivers of growth in the post-COVID era in the last 5 years for India was a significant revival in India's capital expenditure, or a meaningful revival in India's investment cycle, and where the central government took the lead. So overall, central government investments have almost multiplied by 3 times over the last 5 years, from 3.5 lakh crores in fiscal year 20 to about 10.5 lakh crores this year, or about 10.2 lakh crores this year, which effectively is a CAGR growth of about over 20% over the last 4 or 5 years. And in terms of contribution, meaning central government's investments have gone up from 1.7% of GDP to almost 3.3% of GDP, where it stands currently. But from here, so one of the approach that the government took in the middle of COVID crisis, when the economy was in lockdown, to significantly increase investments in the economy and use investments as a driver of the growth. All of us know that the multiplier effect of accelerated investments is significantly higher in the economy than the multiplier effect of consumption. But having said that, now the government has now made a pivot where the central government feels that it has done its part. And from here on, while this year has been an exceptional year where the government has actually underspent on the capital expenditure, but from a next year perspective, the budgeted growth is very much in line with India's nominal GDP growth. So central government investments are likely to increase at about 10% next year on a BE terms over the FY25 RE, and will stay at about 3.3% of GDP in that sense. So I think the government has clearly made a pivot in that sense, where the central government feels that it has done its part in terms of accelerating or reviving the investment cycle. And there's been a larger allocation towards consumption this budget, which we have clearly seen in terms of tax breaks, and we'll talk about that. But in terms of investments, the central government thinks it's done it. So central government investments from here on because this is the first full budget of this government, more importantly from a directional perspective, during the course of this term, probably I think the expectation from here on would be that investments for central government will grow in line with nominal GDP growth, which effectively means that they will stay at a current run rate of about 3.3% of GDP, and from here on they should grow at in line with nominal GDP growth. Having said that, within that also, when you look through in slightly more detail, obviously there is some new categories that the government has announced in terms of focusing on investment. So if you look at the 3 big sectors, which were the core sectors for driving government investment in the last 5 years, which is defense, railways and highways, central government investments in these 3 sectors have actually gone close to 3x in the last 5 years, from 2.5 lakh crores to, on an aggregate basis, about close to 7 lakh crores or slightly over 7 lakh crores. But next year, investments in these 3 segments is growing at a very modest rate of 3%. So while overall investments are growing at 10%, there are other areas of investments, including nuclear power plants or nuclear energy, and few other areas which the government has identified where the government wants to lay thrust on. But these 3 segments are having a very modest growth of 3%. And we believe that as a result, this will have an impact on growth rate of companies within these sectors, because when the overall allocation of the government reduces in terms of rate of growth, while the absolute allocation is still growing, but they're growing at a much slower rate now than what they've grown in the last 5 years, it will definitely have an impact on the sectoral growth or growth of companies within those sectors in that sense. Obviously, the one big pivot that the government has made is towards consumption. There's been a big tax break that the government has given towards consumption this year. Over 1 lakh crore has been given. All of us know that in terms of tax breaks, where the minimum where the tax exemption limit has been increased effectively from 7 lakhs to 12 lakhs. So a person up to 12 lakhs rupees, by virtue of the exemption he gets, does not have to pay tax. And I think probably that's a move in the right direction, because all of us know that there's been a very sharp slowdown in consumption in India over the last 6 quarters actually. Rural consumption, it's been about it's over 6 quarters where rural consumption has slowed down in India. Rural consumption started slowing right from middle of June of 2023. And it's been 6 quarters that the rural economy has been impacted because of slowdown in the consumption. And over the last 4 quarters, we've seen a meaningful slowdown or deceleration in urban consumption as well. So the rural slowdown has actually spilled over into urban consumption. Some of that, I think, did get reflected in terms of the outcome of the national elections we had last year, where the incumbent government was expecting to win over 300 seats, but they ended up with much lower. And to some extent, I think it was a reflection of a slowdown in the consumption and probably it impacting the lives of people, which reflected in the vote share. So I think, and I think what the government has done in terms of tax breaks is very, very significant, because a person up to 12 lakh rupees, which effectively means almost close to about $14,000 of per capita income, does not have to pay any income taxes in India. I think that's very significant in the context of the fact that the per capita income in India is about $2,700. So anyone earning 4 times the average income of India, 4 times India's per capita GDP or per capita income, does not have to pay taxes. This is very significant, and effectively out of 3.5 crore taxpayers, almost close to 1/3 of the taxpayers, or 1 crore taxpayers, will benefit and will escape the tax net completely. So that's very significant. I also firmly believe that this will play a very pivotal role in terms of reviving consumption in India, both in urban India and in the rural India. So while our hypothesis was that while consumption has slowed down in India, and after this move, I feel much more confident that we certainly will see a revival in consumption in India going forward into the next financial year. In that sense, so it looks like clearly from a consumption revival point of view, the worst is clearly behind us in that sense. So that's the high level view on the economy and the big pivot that the government has made. And while doing all of this in terms of giving such a big consumption boost, the good thing, as I said, is the government is stuck to its path of fiscal consolidation and fiscal discipline by sustaining fiscal deficit at 4.4%. The slowdown in the economy was visible in various other macro trends which were visible over the course of the last year or so. For example, for the last 5 months, GST collection has been growing. Monthly GST collection, which is a reflection of underlying economic activity, has been growing at single digits. So, and probably the slowest rate that we have seen in the last 4 years. So, and which was again a reflection of slowdown in the consumption or the expenditure by households. To summarize all of this, I believe that the fact is there is a growth moderation in the economy. This year, as I said, our growth will be about 6.5%. More importantly, we also believe that over the next 2 years, we think India's growth rate will be similar, because for the last 2 years or the last 3 years, we've had we also have had global tailwinds, and we think some of those tailwinds can actually turn into headwinds as well, and globally the environment will be far more challenging in that sense. So 6.5% growth in that kind of environment is still not bad, but having said that, we need to consider that will be somewhat lower than what the growth we've experienced in the last 3 years. For the timing, it looks like the government is done with significant economic reforms. We have not seen any significant or big disruptive economic reforms from this government over the last 2 years of their previous tenure, and at least so far we are almost getting closer to, meaning we are already 7 months into their new term. We haven't seen any significant disruptive reforms from this government. So looks like the government for the time being is not intending to do significant disruptive economic reforms. Probably the reforms they are looking to pursue are non-economic ones. Obviously, for example, one nation, one election has been a priority for the government, and some of those reforms which are outside their realm of economy, which is still not bad. Central government capex has grown significantly over the last 5 years, but it is now apparent that has peaked. So that's effectively markets, from equity market perspective, markets are always looking at the rate of change or the rate of growth. And the point here is that while central government capex was growing at 20% CAGR over the last 5 years, from here on it will grow at 10% CAGR. We've seen some revival in private sector capex from where we were 5 years back in the middle of COVID crisis. Having said that, we should concede that private sector capex still has a room to catch up. The revival has been much more modest than what was expected. That whole conversation about revival of animal spirit in private sector, that's clearly not the mood. The mood of corporate India or of private sector is more of cautious optimism. So companies are willing to invest, and they are investing, but only to the extent they see visibility of growth over the next 2 years. So the mood in corporate India in terms of when it comes to investing and private sector capital expenditure is more of cautious optimism in that sense. As I said, rural and urban consumption has been very slow, but I think after this budget, I'm much more confident of recovery in both rural and urban consumption. And more importantly, the bigger beneficiaries will be, we think, probably building materials or staples. Definitely in the rural India will benefit from this, but more importantly, we also see a revival in consumer durables as well, and probably small cars as well. So all of these segments of the economy should be a beneficiary of the consumption boost that the government has given in the budget. Having said that, we need to concede that the slowdown in the economy has actually spilled over into slowdown in the earnings growth, and there's been a deceleration in earnings growth. And with that, maybe I can quickly move on to some market outlook update. So clearly, this is what I was talking about. Last 4 years, corporate earnings in India has grown at a CAGR of about 17%, and actually in last 4 years they've almost doubled. What we use as a reference point or a benchmark of Nifty 50 earnings, which was about 450 rupees, 470 rupees during COVID FY20, it has actually doubled over the last 4 years until FY24 to get to almost 1000 rupees in that sense. This year is the slowest year in terms of earnings growth that we are going to witness for corporate India in the post-COVID world. This year's earnings for the Nifty 50 companies will grow at a modest 5% or thereabouts, which is very slow. More importantly, we think over the next 3 years, earnings growth for corporate India will be in probably high single digit or low double digits at about 9 to 10% CAGR. Having said that, given that this year's earnings growth is just about 5%, we think the revival in earnings will be back-ended, which effectively means we still think that earnings over the next 2 years can grow at 13% CAGR. But still we need to, over a 3-year cycle, we expect earnings growth to be at about 10%. So clearly the slowdown in the economy that has happened has spilled over into a slowdown in earnings, in revenue growth and profits or earnings growth for corporate India. It's very much visible now. In middle of all of this, equity markets, meaning all of us know markets is pretty well until September of last year, and from between October and December last year, markets corrected by almost 8 or 9%, and this year, start of the year, last 5 weeks, we've had a meaningful correction again in the mid and small cap. But after this correction, now what we see is, if you look at the valuations of markets, and last 2 years, maybe another trend which was very evident was that we've seen that higher the risk, higher the return. So last 2 years, we've seen Nifty mid cap has given a much higher return than large caps, and small caps have given much higher return than mid caps. But I think it's a time, we've reached a stage where probably we are in for a mean reversion. If you look at valuations, after this pullback, we think at least large caps are now trading at reasonably fair valuations at closer to about 21 times end of December. And more importantly, after this pullback that we've seen in the month of January or in the last 5 weeks, large caps are now trading, the Nifty 50 index is trading at about 19.5 times forward earnings, which is pretty much in line with the averages that the Nifty has traded over the last 15 years. So valuations at the Nifty 50 index, aggregate index level, are pretty much in line with long-term averages, and I think a significant part of froth is taken out of Nifty 50 in that sense. So, but having said that, valuations in mid caps and small caps still remain pretty expensive or pretty rich, and they are trading at significant premium to large caps as well. So we think that the moderation in valuation or mean reversion or pullback in mid and small cap will continue during the course of at least the first half of this year. So while we've seen some very sharp pullbacks in mid and small cap names or in stocks over the last 5 weeks, we still think that there is a lot of froth that's out there in mid and small cap, and one should be very careful in terms of investing into mid and small caps. So from our overall outlook perspective, given the fact that earnings growth have slowed down, and this is a year where we have one of the slowest earnings growth, we've had slowest earnings growth. More importantly, while we expect a revival from earnings growth, revival from here on, from the low point that we are, but we still think that the revival will be more back-ended toward the second half of next financial year rather than the first half. So we still think the revival will be more gradual in that sense. And in that context, we think that the first half of this year from an equity perspective will be somewhat more challenging, and probably we see a recovery in the second half. We still think, if you ask me, I still think that this year will be, if you look at the index returns, last year Nifty index did about 9% return. Having said that, last 3 years the Nifty index has done about 12% CAGR, 12.2% CAGR to be very precise. I still think that from here on over the next 3 years, Nifty can comfortably do a 12-13% CAGR, which is pretty much in line with the earnings growth that the Nifty is likely to do over the next 3 years. I think this year could be slightly more challenging for mid and small caps, where because there's still a lot of excesses in terms of valuations that exist in mid and small cap. And given the fact that the economy is slowed down, a lot of these mid and small cap companies are trading at valuations which are still very rich. So at some point of time, either there will be a realization within the market that these companies cannot deliver the growth expectations that is already built into the stock prices, and which effectively means there will be either a price correction or a time correction in a lot of mid and small cap names. So which is where we think that the mid cap small caps will still undergo some form of correction or mean reversion or price pullbacks during the at least first half of the year until we see some normalization of valuation. But as far as large caps are concerned, we think large part of the froth is taken out, and we feel pretty comfortable with large caps from here on. Though this quarter could be challenging, but at the same time I also believe that this is a great time to build a portfolio with a slightly more medium term to long term perspective, because in a high growth market like high growth economy like India, we do not get these corrections very often. So the last time we had a big correction in the market was in the quarter of Jan-March 23, and after that we had a very strong or a ferocious move in the market for almost 18 months. I think likewise from a medium term perspective, the outlook for the economy still remains reasonably good or reasonably healthy, and in that context one should use this correction to build portfolio for the longer term. But probably I would advise that at this point of time any portfolio should have a significant large cap skew versus mid and small cap at this point of time, and probably recalibrate towards, we can revisit mid and small caps maybe towards the middle of the year in that sense, once we see more normalization of valuation. So and just to put this more in context, I think the good thing or the beauty about Indian equity markets is this slide captures that. If you look at the last 14 years, despite the ups and downs or the volatility that we have seen in the economy and so on and so forth, Nifty 50 index, if that's the representative of the market, has actually delivered positive returns in 12 out of the 14 years in 12 of the 14 times in the last 14 years. So effectively on a full year basis, Nifty 50 index has given negative returns only 2 times in the last 14 years, which effectively tells you that any investor investing into equity markets and having a time horizon which is 1 year or longer, his probability of losing money is only 15% of the time. 85% success probability of making money on a 1 year basis in equity markets is very, very high probability, friends. The good thing is it reflects that Indian economy has become much more stable economy. More importantly, it also tells us that Indian equities as an asset class has become much less riskier, and which is also reflected in the significant decline in volatility of Indian markets or the index volatility over the last 10 years, where the Nifty vols have declined significantly, and which effectively means that it's become a much more, I would say, much more stable and much more safer asset class versus what it used to be historically in that sense. And I think that's a very positive thing. So I still think that while this year will be a modest year in terms of returns expectation, but still over the last 3 years Nifty index has done, as I said, about 12 to 13%, 12.2% CAGR. I still think that we can do a 12-13% CAGR returns over the next 3 years, and within that active managers like us will endeavor to obviously generate alpha over and above that. A well managed fund, actively managed fund, can comfortably do a 4 to 5% alpha over and above the index returns, which effectively puts the portfolio returns at the client level somewhere between 15 to 20%, and which are very healthy returns from equity as an asset class in that sense. So, just to summarize, friends, in line with the economy, we've had or we're experiencing earnings slowdown in the economy. Over the next 3 years, we expect Nifty earnings growth to be about high single digit, low double digits. And but the good thing is, as I said, after this pullback, Nifty valuations are pretty much in line with long-term averages. And from here on, while there might not be significant market momentum, but returns will be made basis stock picking. So it will become more a stock pickers market rather than trying to chase momentum in the market, and bottom group stock picking will make count in these markets in terms of ability to identify right businesses within the right sectors or the industries and probably invest into those stocks. I think that is what will make returns. So that's a quick brief on in terms of how we are thinking about economy and markets, and to bring you up to speed in terms of the impact of the budget and give you a high level perspective on the economy, and more importantly the outlook for that, and what's happening in corporate India, and how all of that means, what all of that means from a market perspective. Maybe I can quickly give you all a quick update on our PMS and AIF funds, and then we share some insights into a portfolio positioning or what changes we are making, and then open the floor for questions. So all of you all know, friends, Renaissance Opportunities portfolio is a large cap PMS. The portfolio, 75 to 80% of the portfolio is large cap, and at any point of time, the fund has done pretty well in the last quarter. Has been a decent quarter since we're discussing October-December quarter. While the Nifty 50 index was down about 8.25% in the last 3 months in October-December quarter, the fund was down just about 2.5% in October-December quarter. So this strongly reflects the low risk nature of the fund. Having said that, yet on a 1 year basis, so calendar year December 24, the Nifty index is up 10% and the fund has been up 24.5%. So which is a pretty healthy performance on a 1 year basis as well. And more importantly, I always endeavor to focus on the 3 year and 5 year performance, because we invest with a 3 to 5 year horizon when we invest in stocks, and which is what we recommend clients to invest into our portfolios with a 3 to 5 year time horizon. On a 3 year basis, the fund has done a 20% CAGR versus Nifty 50 returns of 12.17, and likewise on the 5 year basis, the fund has done 20.95% returns versus Nifty 50 CAGR of 15.5. So pretty healthy performance, friends, across time horizons in that sense. And more importantly, as I said, while we endeavor to achieve healthy returns on the fund, more importantly on a consistency of returns is very important for us, and which is what we've been able to demonstrate in terms of performance across time cycles from 1 year to 5 year. More importantly, and while we as investors, we invest into high growth companies, but at the same time it also reflects the low risk nature of our portfolios, and which is one of the most essential pillar of our whole investment framework, and which is reflected in the last 3 months performance, where you've seen that while the index, Nifty 50 index is down 8% or over 8%, the fund is just down about 2.5%. So pretty pleased with the performance of this fund, and I'm sure so are you. One big shift that you will see across our portfolios, including this fund, is we have significantly pared down during the last quarter, and even in this quarter, we have pared down our exposure to cap goods engineering as a sector, and this is pretty much in line with the macro shift that the government is making. Government is one of the biggest investors or spenders in the economy, and incrementally they are spending more money on reviving consumption, then accelerating the investment cycle from here on. The government has done its parts on the investment cycle. Well, they'll sustain their current investments, but in terms of the delta change, we see a bigger delta change from the government because of the government's change in government's allocation coming to consumption oriented sectors. So industrials, which used to be about 15% of our portfolio about 9 months back, is almost down to, when you get to see the January portfolio, down to single digit exposure, and we are increasing our exposure to consumption and consumer discretionary. So you can see here consumer discretionary consumption is already 11% of our portfolio, and this number will go higher because we want to align ourselves with the government outlays, and that is where we see a bigger delta coming in. Also, consumer oriented sector and consumer companies have actually underperformed. So because of slowdown in the consumer as a sector has actually underperformed from an equity market perspective over the last 3 years, and all consumer companies have actually underperformed the index. So clearly we see an opportunity here where we find some very good quality companies trading at much more reasonable valuations, and probably we think some of these companies can deliver much higher or superior returns over the next 3 years, and which is where our tilt of the portfolio is. Apart from that, over the last quarter, from a portfolio perspective, we also increased the allocation to private sector financials. Within that, some of the prominent names that we've added to this portfolio includes names like, we've added our weight to HDFC Bank. So it's the largest holding in the fund. It's a stock, I know, that's not delivered any return in the last 3 years, but we have turned largely constructive on HDFC Bank in the last 1 year, and which is where in the last 6 months we've added meaningful weight to the portfolio. We certainly think that HDFC Bank will do pretty well over the next 3 years. They are in the last leg of absorbing their merger with HDFC, and we certainly think that over the next 3 years, from 3 years from now, they have every possibility to once again re-emerge as India's fastest growing private sector bank, which is what HDFC Bank traditionally has been for almost over a period of almost 25 years before they got into merger with HDFC, and which has impacted their growth trajectory or growth momentum. And at the same time, from a valuation perspective, it's trading at a pretty attractive valuations. It trades at about 14 times forward earnings, which is very attractive. I haven't seen HDFC Bank trading at such multiples or available at such a value price or such a valuation in the last 27 years of the existence of the franchise. And we firmly believe that at the core, the franchise remains very solid. It's a very solid franchise. What has really impacted their growth in the last 3 years has been their whole process of integration with HDFC, the big merger that they did and the integration with HDFC. But we think they're doing a great job on that, and probably in about 3 to 4 quarters, they should be done with that, and from there on, they'll reap the benefits or fruits of that. So we pretty constructive on that name, and that's very much a part of our portfolio, and you can see that's our top holding now. So the point is, the portfolio, we have very much, our portfolios, we are razor sharp in terms of our focus, in terms of making sure that our portfolios are pretty much aligned with our whole investment framework of investing into high quality, high growth companies at reasonable valuation. So while we want to own high quality companies, we want to own high growth companies, but at the same time, we are very mindful that we want to buy these businesses at reasonable valuations or healthy valuations. We do not want to buy high growth companies that are at fancy multiples or very expensive valuations, because that carries its own set of risk in terms of valuation derating of companies, which is not what we do as investors. So we feel pretty good about how this portfolio is placed. And as I said, the portfolio has done pretty well over the last 3 years with 20% CAGR returns despite all the volatilities in the market. And we feel pretty constructive in terms of the portfolio we have on hand. We feel it's a rock solid portfolio with some of the best franchises that exist in India across sectors, be it private sector financials or IT companies or consumer companies. And between these 3 sectors, we have almost 2/3 of our portfolio is within these sectors, and these are some of the best. These are the companies that we own are leaders in their own sectors, and these are some of the best franchises run by some of the best management teams in the world. So we feel pretty good about the portfolio that we have and what this portfolio can deliver in terms of returns, despite somewhat, let's say, a slowdown in the macroeconomy or a challenging global environment. We feel pretty good about our portfolio. Quickly, our FlexiCap portfolio, which is the Indian XPMS, you have the portfolio snapshot here again. Again, we've had a great run with the portfolio. You can clearly see last 1 year ending December 24, the portfolio is up 32% versus Nifty 200, which is the benchmark for the portfolio, at about 14.75%. More importantly, as I always say, look at the 3-year and 5-year returns. On a 3-year and a 5-year basis, the portfolio has done 27% CAGR versus index CAGR of 14.5 and 17%. So pretty healthy performance across time horizons once again. And again, keeping in line with our philosophy, in the last quarter when the markets were volatile, while the Nifty 200 index was down 8%, this portfolio is down just about 4%. So our portfolios have shown the resilience in terms of, one, delivering much better alpha and much superior returns versus the index benchmarks. At the same time, it reflects or it demonstrates that we are generating those high returns without taking, or healthy returns without taking high risk, and which is why whenever there is a drawdown or pullback in the markets, our portfolios drawdown or pullbacks are much lower than that of the index, and which is what again is reflected in this quarter's last quarter's portfolio as well. While the last quarter index was down 8%, the portfolio was down just about 4%. Again, similar reflections here, where the portfolio, this portfolio will gravitate more and more towards consumer-oriented names, and we will take money off. We've already taken money off industrials, and probably you will see more consumer-oriented names being part of the portfolio, being flexi-cap portfolio. This portfolio will be, there will be some changes that we are in the process of making the portfolio. You will see the portfolio at 50% large cap and balance 50% between mid and small cap. Having said that, while we remain cautious on mid and small cap, but having said that, we've done a very deep drill down on the investments that we have in the mid and small cap companies in terms of their growth outlook and in terms of valuations, and we feel pretty comfortable with the growth outlook and valuations of the companies that we have in our portfolio in that sense. And obviously in our whole investment framework and analysis, given the backdrop, economic backdrop, we are laying a higher emphasis on visibility and certainty of earnings. So we want to make sure that our companies are, we are going, or we are doubling down on companies with higher certainty of earnings growth than chasing higher earnings growth by itself. So while we certainly want earnings growth, but we want those earnings growth with high degree of certainty, or we want companies, best in class companies that can deliver that earnings growth despite a challenging environment. And clearly that effectively gravitates a portfolio towards even higher quality companies, and which is where, when you have those kind of companies in the portfolio, then even when equity markets are volatile, those companies, because the kind of they keep delivering results, or their fundamental performance quarter after quarter and year after year, their stock prices tend to be far less volatile and probably have much lesser drawdown, even in an environment where markets have had a sharp pullback, and which is what exactly we are witnessing in our portfolio as well. A quick update on our mid-cap portfolio again. In our mid-cap portfolio, we again, given our cautious view on mid and small cap, we've been somewhat again much more cautious, and we have been very mindful of owning companies with reasonable valuations in that sense. And while last year has been somewhat challenging because we have not participated in the significant froth that existed in the whole mid cap and small cap space, but we think this year should be a decent year for us, for our portfolio in that sense. Having said that, on a 3-year basis, this portfolio, despite a challenging last year, has still done a pretty healthy returns. You can see at 23.5% over the last 3 years, which is pretty healthy, and despite a low risk nature of our mid cap portfolio. So though last 1 year has been a challenging one, because in most of the mid and small cap companies we have found valuations very expensive, and we have stayed away from that, participating into that froth or momentum in mid and small cap space. But we think that should pay us dividends this year, because as that froth comes off, probably we should stand to benefit, as we think our portfolio companies will have much lower downside, and probably in a year like this where mid and small cap could be challenged, our funds can still deliver healthy positive returns in that sense. In that sense, while last year has been challenging, but we feel good about the fund going into this year despite challenging outlook for mid and small caps. A very quick update on our AIFs as well. I thought I'll take this opportunity to update you on AIF as well. Our Indian X Fund 2 continues to do pretty well. Last year again was a good year for the fund. The fund did 39% return last year versus the Nifty 200 return of 13%. And even last 2 years, the fund has done a 34% CAGR versus Nifty 200 of 18%. All of you know, the Indian X Fund 2 was more indexed towards tech-oriented companies with underlying theme of bits, So the fund has done pretty well so far. We are almost 3 years into the life of the fund, and it's done pretty well in that sense. Last quarter as well, despite Nifty index being down 8%, the fund was almost flat. So very strong outperformance from the fund in the last quarter. The Indian X Fund 3 is launched in August 23, so almost 6 quarters into the life of the fund. Last year has been a pretty healthy year for the fund. The fund is up 26% versus Nifty 50 returns of 8.8%. Again, the same story. Last 3 months, the drawdown has been much lower. So you can see this pattern across all our funds, where on a 1 year, 2 year, 3 year basis, the funds have delivered very healthy returns. And then when markets turned challenging in the last quarter, October, December quarter, all our funds have had very meaningful outperformance versus the benchmark, which effectively reflects the low risk nature of our funds in that sense. With that, we already on top of the hour in terms of time. So maybe we are at 4:45. So I can take a pause here. That was a quick update or rundown for all of you on our funds. And I can open the floor for questions so that we can take some questions and address queries you have. If you have any questions, feel free to type it into the box that you have on the link, and I'll be happy to answer any questions that we are not able to answer now. We'll make sure that we'll send you a reply by email. Make sure to mention your email address as well. The first question I have is from Kulbir Oberoi, which is market outlook over the next 12 months. How much more time for correction? What is the expectation of the fund over the next 12 to 24 months? So I think I covered some of this, but I'll just reiterate. I still think that at the index level, last year Nifty 50 index CY24 did about 9% return on a full year basis. I think this year could be something similar. Nifty index doing a single digit return, where more importantly the returns could be towards the second half of the year. The first half could be a bit more challenging from a market behavior perspective, and we've started markets on a note where markets have pulled back. But having said that, I still think that this year could be a single digit return. More importantly, over the next 3 years, Nifty can still do what it did in the last 3 years, which is about 12 to 13% returns, which is a reasonably decent outlook, I think, in that context. Returns from our funds, active managers like us, meaning last year has been phenomenal, last 3 years have been phenomenal, but I would say that the expectation from us should be probably at least a 5% alpha over and above the index returns. So if index can do a 12% CAGR returns, we certainly aspire to do at least 15-20% returns from our funds over the next 3 years. That kind of a CAGR is what we look forward to do it. So that's the quick answer to your question, Kuldeep. Next question is from Prabhat. Tripathi is investing in IT companies a medium term and long term risk due to generative AI development and Trumponomics. Good question. So Prabhat, actually that's certainly not the case. We think AI will help Indian companies, because eventually today AI needs to be implemented. Yeah. Once any innovation happens in IT, this thing that has to be put to work. All global companies or every company, large or small, will have to adopt AI, will have to build use cases, and that will have to be implemented. When AI currently even large companies are doing small projects in AI. Probably in next 12 to 24 months, I think AI driven projects will become meaningful or sizable in that sense. And IT services company will be the one which will do implementation. India, all of us know, controls almost 60% market share in IT services globally, or Indian companies control that market share. So we believe that as AI driven projects gets into implementation phase, Indian companies will be a big beneficiary of that, and that will drive growth for Indian companies. So we are actually more positive on IT companies and the evolution of AI helping Indian companies. They will have to make transition in terms of reskilling their workforce, but they are already doing that, and they've dealt with multiple technology shift or cycles in the last 30-40 years. So we don't have any doubt on ability of these companies to manage the technology shift or cycle in that sense. As far as Trump policies are concerned, we again believe that Trump is not anti-IT, because the economics are very clear in terms of the cost savings that offshoring brings to US companies. So offshoring is now pretty much mainstream and very strategic to the US economy. So we don't see him doing anything which really hurts offshoring or IT companies in that manner, and we don't see that having any negative impact in that sense. Yeah. So our view on a medium term to long term basis on IT remains fairly positive in that sense. The next question is from Uh, Hitesh, okay, the next question is from uh, Mahendra Prajapati. What's your view on global debt, recession due to deglobalization drive or tariffs? So, we need to acknowledge or concede the fact that the world is going through deglobalization. I don't think so. There is any debate on this now. The world is getting more insular, and the way the world is poised, at least over the next 5 years, given Trump firmly believes that tariff is one of the big tools that he holds in his hands to drive his agenda of policy making in US, or trying to get partners, trade partners or alliance partners, to get a deal out of them. The world is clearly getting there, which effectively means the world will remain headwinded. Having said that, the silver lining for India is India's market share in global trade is still very small. We are less than 2% of global trade. And because US certainly intends to impose, or they've already imposed the first round of tariffs on China, US-China trade is very significant. India can actually benefit from a shifting of some of those US-China trade to India. So effectively, this whole China plus one, or rebasing of supply chain or relocation of supply chains outside of China can towards India can actually accelerate, because of the accelerated tariff that US or Trump will impose on China in that sense. So the higher tariffs might have some impact on some segments of the economy, but we could also be a beneficiary of, as I said, relocation of supply chains outside of China. And India being a friendly country, we don't see significant direct tariffs on Indian trades with US, because our trade from a US perspective, what India trades with US from a US perspective is still very small as compared to some of the other trading partners. So net, I still believe that India will not be significantly negatively impacted from trade tariffs in that sense. Having said that, it will certainly have an impact on global growth. So globally growth could slow down. So I think that's a medium term risk, that globally the world should be prepared that the global growth can slow down, but I don't see significant negative impact on India in that sense. As far as global debt is concerned, I think you are referring to US debt. Obviously, all of us know US debt is significantly higher. But having said that, all of us understand that it's a reserve currency. So they can just, as long as the markets are able to absorb it, they can just do anything and just get away with it. So meaning, while those are some of the issues, but I don't see they having any destabilizing impact on the markets from the next 2 to 3 years perspective. So I don't see that. Longer term, much more longer term, yes, that's an issue US has to really deal with, but I don't see it impacting markets from a next 2 to 3 years perspective. Next question is from Hitesh. The question is view on dollar index and US markets. So okay, on the dollar index, it's very apparent. See, if you read through or listen to whatever Trump is saying, 2 or 3 tools or he has in his playbook that he wants to use. Obviously higher tariff. Second on the agenda, or second in his playbook, is a stronger dollar. So I believe the dollar as a currency will remain strong over the next 3 years, because or 4 years of Trump's this thing, because that's the part of the strategy or the toolkit that he has. But from a very near term perspective, probably because dollar has had a strong rally in the last 6 weeks post the election outcomes in US, probably there could be some pullback. But I still believe that we are in for a stronger dollar over the next 3 or 4 years, because that's one of the tools that they actively intend to use, and the whole framework or the view that US being whatever a leader and a stronger country should have a strong currency. So I think we are in an era of a stronger dollar in that sense. On US markets, well, I'm not an expert, but I firmly meaning I like to believe that valuations there are extremely rich. Markets are trading at 22 times the highest multiples that we have seen outside of the 99 IT bubble. In US, S&P 500 is trading probably at the most expensive level that we have seen in the last 25 years. I think at some point of time there will be a pullback in US markets. Having said that, the underlying economy in US still continues to remain resilient. So overall, our markets might still do okay, but I think they are poised. Some point of time, they're poised for a pullback or a correction in US markets. The next question is from Zahir Hussain. In the budget, textile sector got a good capex. What are the stocks to look out for? What's your view on textiles theme and green energy theme, where the budget emphasized on nuclear? There are too many questions which are bunched up into it. Well, Zahir will avoid talking about specific stocks on this call because of compliance reasons. But having said that, nuclear energy, it's too early. Meaning government has just made policy announcements over a period of time. Yes, this should build traction, and probably we'll see companies in the space beneficiary of it, but it's too early in that sense because these are just high level policy announcements the government has made. As far as textiles is concerned, textile sector has been going through a slowdown over the last 3 years, but in the last 6 months we have seen initial signs of revival in the textile sector in India, and that's been largely because of the dislocation that's happening in Bangladesh. So a lot of textile trade from India which moved to Bangladesh is actually coming back because of the instability that's going on in Bangladesh, and that should help India. Having said that, the state still faces some near-term headwinds in terms of slowing growth in Europe because some parts of Europe are in recession. So while the longer-term outlook in terms of India's increasing market share is positive, but yet it will go through its own cycle in that sense. Next question is probably I'll club couple of questions. So what is our view on high growth EMS companies such as Dixon and Keynes? Again, I'll avoid company specific comments, but at the aggregate level, we think, meaning we have exited our exposure to EMS companies because we think, well, the growth in the underlying sector will continue to remain strong, but we think valuations are very rich in the sector. The valuations that the stocks were trading at 4 weeks back were already capturing in the growth over the next 3 years or 4 years. So stock price is significantly ahead of fundamentals, and we think it was not making sense from that perspective. So one has to be very careful about the valuations in the space, while the underlying growth will continue to remain very strong in that space. So that's in summary our view is. Next question is from Uday Singh. FIs are continuously selling. How do you see this? And if FIs continue to sell for the next 2 or 3 years, what impact would it have on the Indian markets? Yeah, that's true that foreigners have been selling, but that's driven by 2 or 3 things. One, obviously, India is one market which has done pretty well over the last 2 or 3 years. Most of the emerging markets have not done well. India was also the most expensive equity market in the world. And in top of all of that, we got a slowdown in the Indian economy, and which is where it made sense for them to take money off India. And there was some fiscal stimulus in China. So, and Chinese markets had a rebound. China was very cheap. Last year, September, August, before the big rebound they had, Chinese markets were trading at something like 8 times forward earnings. So it made sense, and foreigners were significantly overweight India. So it made sense for them to cut down their position in India and probably reallocate to some of the other countries where valuations made more sense. I still think that probably some of this FI selling will continue during the course of this quarter. So probably until March or something like that. And probably sometimes middle of the year, I think, I don't see an environment where FIs will keep selling in India for the next 2 or 3 years. I don't see that as an environment, because whenever valuations become more reasonable and the growth outlook becomes more stable and brighter, I think they will come back, because at the end of the day, they are very objective investors. So I certainly think that foreign flows to Indian markets will come back, or FI flows will turn positive probably in the second half of the year. But some of this selling might still continue for the rest of this quarter at least, and probably foreigners maybe turn buyers again towards the later part of the year. Next question is from Keur. The role of AI in financial industry 5 to 7 years. Well, Keur, while it's very meaning I cannot see exactly each and everything that will happen in 5 to 7 years, because 5 to 7 years in the world of AI is very, very long period of time. Things are changing very quickly in a very short span of time. But yet I can assure you that in financial services, there will be very significant and very deep changes that will happen in the next 5 to 7 years. Just think about it, meaning all of us know today the largest broker, retail broker in India is a digital company which started just about 15 years back. Yeah, today all of us do most of our payments using UPI handles through which is just about, as an innovation, just about 10 years old. So the impact of some of these changes are so fundamental and so deep that it changes human all our behaviors and habits forever. Now we are not going to go back to making payments through any other mode but UPI. That become part of our lifestyle. In the broking industry, customers are now used to doing DIY or trading on their own, a significant part of the customers, and they are not going to go back to the traditional broking houses. So I think likewise, AI will only amplify and accelerate very significant disruption and transformation that will happen across each and every segment of financial services, be it capital markets, be it banking, be it savings, be it insurance, lending. Each and every segment of capital market or financial services will be touched and transformed by AI in that sense, and that meaning I think the transformations will be very significant. Companies which are able to change with time are the ones which will grow and prosper, and companies which do not keep pace without transition will actually lose out. So it's a very significant challenge for all the players in each and every segment of financial services. Yeah. Next question is from, I've already covered this, from Satish. What's the view on consumption in light of the tax exemption limit being increased to 12 lakhs? Well, I feel pretty good about it. I feel that will certainly help in a meaningful revival in consumption in India, both in rural consumption and in urban consumption. And I think we should start seeing that from the second half of this year. It will be more gradual, but I certainly see it playing, it acting as a catalyst in terms of revival of consumption. So the view out there on consumption as contribution to the economy and on consumer oriented stocks is positive. Next question from Ajay is, what is the view on cap goods and infra stocks? Well, Ajay, the outlook there is slightly more cautious and muted, I think, meaning just to put it more succinctly, last 3 years companies within the capital goods and infrastructure sector were the best performing companies in the last 3 years in the stock market, and the sector was the best performing sector in the last 3 years. I certainly think that the next 3 years cap goods and infra is certainly not going to be the leader. The leadership will emerge from some other sectors. I think my bet is on financials and consumers. So I think it's not a bad time to take some money off the table from cap goods and infra companies and reallocate that money to other pockets of the economy or other sectors of the markets where valuations are far more reasonable. The bigger challenge with cap goods and infra companies is that the valuations in the sector are very expensive. Even small cap companies are trading at 40, 50, 60 multiples. So the earnings growth that is implied or built into those companies is very high, and most of these companies or many of these companies are unlikely to be able to meet those kind of earnings growth that is impliedly already built into the stock prices, which effectively means we believe that at some point of time there will be a mean reversion and correction in a lot of companies in cap goods and infra, especially in the mid and small cap space within the sector. So the view out there is somewhat more cautious. The question from Hitesh is the top three sectors that we think will do well over the next 3 to 5 years. So Hitesh, as I said, the top 3 sectors for us are private sector financials, lenders, essentially the larger cap banks. We like IT as a sector, and more now post budget, we think consumption as a sector is going to revive. So we are reorienting or we are increasing our allocation to consumption. So these are the top 3 sectors which I think will really do well over the next 3 years and our biggest allocation in our portfolios as well. We have some more questions, but friends, we are already on top of the time. We already crossed 5 o'clock, so we'll take I'm going to take a pause here. We're going to conclude the call here, and any unanswered questions, we'll try to reply them over the mail. Thank you all very much for taking a valuable time out for this discussions, and if you all have any more queries, please do get in touch with our sales team, our sales representative, and we'll be happy to answer your questions or queries. And thank you all until we speak again at the end of next quarter. Thanks a lot.